Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. And just as folks are signing in, don't forget we've been looking at different risk events, particularly that are coming up here in the workshop with the Bank of England interest rate meeting and the Swiss National Bank interest rate meeting coming up tomorrow morning for the Swiss and tomorrow afternoon at midday for the Bank of England. Don't forget, as we talk about different instruments, different trading outlooks, the whole idea of this workshop is not a trading advice. It's simply me outlining what I'm expecting coming up from these central bank moves and how I'm personally looking to trading them. It can't obviously be a signal trading service because market conditions change so rapidly. However, this is an exciting meeting that we have, and we've already seen a little bit of movement in the pound that I'm involved with ahead of the Bank of England meeting. So I'm just going to go through that. Very nice to have you here, Laritza, Fahad, Gabriel, Ignatius, Kingsley, Mihai, Mustafa, Pani, Saeed, Salman. Great to have you here. Don't forget, if you want to get my attention during the webinar, don't forget to ask a question. Just type it in the Q&A box or the chat box. Very happy to always answer any questions that you may have as we go along. Right, without further ado, let's get stuck in to the webinar. And we're going to look, first of all, at the Bank of England. I want to look at the Bank of England first of all. Even though the Bank of England data is coming later tomorrow, I'll just show you. So Bank of England data you can expect to come out at midday tomorrow. And expectations are for a 25 basis point rate hike. But the reason I want to look at the pound first of all is because we've had this inflation data out from the UK just now. And what we saw, something very interesting is inflation data, is unfortunately for the UK, we've seen the core inflation move up higher. Now, coming into this event, this inflation data was always going to be crucial for the outlook in the Bank of England. Because what the Bank of England wanted to see is inflation falling lower. Now you can see that there are some costs falling lower, particularly PPI. So producers are seeing less inflation, but some upward revisions to the PPI data. But the core is concerning. You see that core reading is 7.1. Now the prior was 6.8. So the core inflation not only has come in above forecast, but it's come in above the prior. And the headline inflation is not only above the forecast, it's in line with the prior. So you can reach no other conclusion except that inflation is definitely moving in the wrong direction. And as I speak, the UK Prime Minister Rishi Sunak is clashing with the leader of the opposition, Keir Starmer, about what to do about the impact of this rising inflation. Now, here's something important to understand. Generally speaking, make sure you understand this, right? This is important for this narrative. Generally speaking, when you see, let me just find the yields. There we go. When you see bond yields moving higher, generally speaking, what you see is the pound moving higher too. But at the moment, you notice, look, bond yields are moving up, but what's happening to the pound? The pound is actually moving lower at the moment. So when you see yields rising, but the currency falling, that is a sign of distress. And let me show you on the index level, it becomes much clearer. We saw a very similar kind of reaction to this with the bond crisis. You see here, you got the 2-year, 10-year bonds, and around the mini budget last year that Liz Truss spectacularly sort of announced to the UK Parliament, and it went down so badly that we had this huge sell-off in bonds. Bond yields just surge higher, and you see normally these track each other. Normally you see rising yields, like here in December 20, rising yields, rising pound, okay, falling yields, falling pounds. But when you have this reaction, when you have rising yield but falling pound, it's a sign of distress. And at the moment, if we just go down to the intraday level, what you can see is yields rise when yields rising, the green and the blue line, that's the 2 and the 10-year. yields rising. What the pound's doing? Candlestick, pound's falling. So that is UK traders looking at the latest data and saying, oh no, this is terrible news. It means there's stagflation on the way for the UK. And that's why we've seen the pound weaken. That's why we've seen euro pound gaining significantly. Now, I'm expecting these euro pound gains to continue. I bought in as the pound gained and just head to that 852 level. I just bought the pound against the euro just as we hit that sort of pivot point with, you know, I could really minimize my risk, make it very, very simple and straightforward for myself. So I'm expecting further gains in the euro against the pound because this is a stagflationary reading. Now, since we've had that inflation print, let's look what short-term interest rate markets are saying. Now, looking at the interest rates, you can see that interest rate markets are now expecting the Bank of England to hike interest rates to nearly 6%. That's right, 6%. Now that is a very steep path of interest rates that's now expected. And that's significantly bad news for UK households and UK companies. It means borrowing costs are going to increase. Now those borrowing costs are already being felt significantly in the UK economy. We're having mortgages, 2-year mortgages. The most popular UK mortgage is now above 6%. We see rents, according to the Office for National Statistics, rent prices are just rising higher because mortgages that landlords have, they're having to pass the costs on to the renters. There's a falling demand as less people want to be landlords, and there's rising prices. Households are likely to experience significant distress. And now the Bank of England, according to short-term interest rate markets, is expected to raise interest rates up to 6%. That is likely to cause stagflationary fears. That's why the pound's selling off. So that means tomorrow, when the Bank of England meet, it's very, very unlikely that they confirm this hawkish pricing that the Bank of England has. See, the Bank of England is expected to raise interest rates to 6%. They're currently at 4.5%. So that is 150 basis points of hikes that's expected. And that is 7 25 basis point rate hikes. The market now sees a 42% chance, that's roughly double what it was prior to the inflationary reading, that the Bank of England is going to hike by 50 basis points. So there is a very strong likelihood that the pound carries on losing value. Why? Because if the Bank of England push against this pricing and say we're not going to be raising interest rates this high, ironically, the pound may actually, it could fall depending on how strong the messaging is, but it could reverse some of these gains. So if the Bank of England maintain this pricing, they're going to have to hike interest rates this high. Investors will look at that and see, oh, that's not positive pound, that's negative because it's going to stifle growth. So that would be likely to accelerate the pound's selling. And if you look at the expectations, you can see that markets for tomorrow, they're expecting the Bank of England to hike interest rates by 25 basis points only. And no economists are expecting a 50 basis point rate hike, but you'll see that short-term interest rate markets see a 42% chance. So if they do hike by 50 basis points, what I'd expect to see is the pound to gain suddenly before traders focus on this bigger picture growth worry. So if they hike by 50 basis points, what I expect to see is the euro pound drop lower into that kind of pivot point area than I'd expect to find buyers. And so for me, like, I will keep my position open, and I would consider in that situation it legitimate to buy from around that 8,550 region with stops just underneath that 8,500. You can just look at this technically and see pretty attractive technically that the euro pound is trying to break up out of that level, and it's not unreasonable to look for a retest maybe up to that 0.8650 region. Very, very interesting level, but a bit of a negative divergence going on here in the pair. So that's what I'm looking at for the pound. So to be clear, if the Bank of England hike by 25 basis points, and if they affirm this short-term interest rate, if they affirm, you know, we've got sort of 5, 6, 7 interest rate hikes to come, and I'd expect that to continue to be negative for the pound. So I expect the pound to spike higher on the hike and then be sold off. So I expect the buy the rumor, sell the fact response. Now, also, if you look at this very interesting tool from Seasonax, you see how over the last 23 years, when the Bank of England hiked interest rates, the euro pound has gained almost around 70% of the time. So from one day before the event and 3 days afterwards, on average, it's returned a 0.57% return, and some of the gains have been good, like 3% profit in some occasions. And then we've also seen other occasions where the profit has been, you know, 1%, 1.3, 1.39, 1.59, 2.9. So there's a lot of times when the euro pound has significantly gained. So I might expect a little dip on the decision and then the euro pound to continue gaining. So that's what I'm looking at for the Bank of England tomorrow. Kingsley, I was due to be in Dubai, but I haven't got a date yet, but I am hoping to be there, probably September or October time now. I was speaking to a university that wanted me to run a course for one of their students, so I'm hoping to get there maybe September, October. If I get a date, Kingsley, I'll let you know. Okay, so now, right, so that's the Bank of England, and that's what I'm looking at there. Now, the next interesting interest rate decision is from the Swiss National Bank that's coming out 8:30 a.m. tomorrow. Now, look at this. The expectations are that they're going to hike by 25 basis points. And there's also an expectation for economists that they might do 50 basis points. Now, this is interesting what's happening in Switzerland. And look at this, right? So we can see Thomas Jordan, June the 8th this is going back a couple of weeks, but it was noteworthy. This is what Jordan said. He said, inflation's more, this is the head of the Swiss National Bank. Inflation's more persistent than we thought, seeing second and third round effects. Swiss rates are relatively low, not a good idea to wait for inflation to rise and then have to hike rates. Very important to bring domestic inflation to a level of price stability. When inflation remains under 2% for a long time, we do not have a problem. So what Jordan's sort of saying is he really wants to get inflation down. Now, let me explain to you why this is a bit confusing, or should I say revealing. This is the G20, and you notice these countries with their headline inflation. Headline inflation for the UK is up 8.7%. It's only worse in Turkey and Argentina, which is a pretty dubious badge for the UK, just showing how the UK is really lagging behind all these other major countries, right? But look at Switzerland. Relatively speaking, the headline is really good. Look, 2.2, and you can see it's heading in the right direction. And then if you look at the core inflation reading, you say, well, actually the core is under 2% at 1.9. And then you compare Switzerland's core rate with other countries. Look, so do you see now why Jordan's comments are a little bit confusing? Because he wants to get CPI below the 2% mark as soon as possible, more persistent than we thought. So what that means is, and if you look at the rate that the Swiss National Bank has, it's not a huge interest rates, but remember, Swiss have had negative interest rates for certain deposits before. So the fact that they're heading positive is significant. Let's not underestimate that. But nevertheless, short-term interest rate markets are seeing the terminal rate for the Swiss National Bank staying at 2%. So what we need to look for, and you can see here, If they hike by 50 basis points, which would take it to 2%, there's only a 60% chance that markets are seeing that's going to happen. So if it does happen, that 40% that we're only expecting 25 basis points will get priced out the market. So you'd expect the Swiss franc to gain, but, and this is the key bit to be aware of in the messaging, if they hike by 50 basis points, but then Thomas Jordan says we're going to pause for now, that's the terminal rate, then we could see some of the Swiss franc strength unwind. And if I just look at the Swiss franc, let me show you. If you just look at the Swiss franc on an index level, you can see, you know, Swiss franc's been gaining, and has now sort of tried to break back into that broken support level and pushing back higher. Now, what we might see, and this is definitely worth looking at, is we might see a situation where the Swiss franc gains on a 50 basis point hike before falling lower if the Swiss National Bank indicate that that's it, the Swiss are not hiking rates anymore. So the sort of pair to be looking at would be like the Euro Swiss franc, really. That's the pair that I'd be, you know, showing some interest in. Let's have a look. Here we go. So if we, and you can see here, the yield spread's pushing higher. So if we see a 50 basis point rate hike and the Euro Swiss franc moves back down this way, I'd expect to find buyers. Why? Because I'd expect to find buyers if there's a sense to which the Swiss National Bank have paused. So watch out for strength on the hike to get faded. Now this, I haven't got as high a conviction for the Swiss franc as I do for the pound. So the key thing is to define a limit risk. So you could use like maybe these 100 or 200 exponential moving average to manage your risk. In other words, if price moved to that 100 exponential moving average, it will be possible to manage your risk underneath that 200 exponential moving average. So if price did take the, you know, reach that area, you just cut the trade. But otherwise, I would expect dip buyers as long as the Swiss National Bank indicate that they're at peak terminal rate. Now, the other option, of course, is Swiss SNB could say, no, the headline is inflation is still above 2%. You know, look, it's at 2.2%. We're not happy. We're concerned. So we may have to hike interest rates further, in which case expect Swiss franc strength. And in that instance, if you saw Swiss franc strength, I'd be inclined to short the pound Swiss franc. Because if the pound's, you know, the pound could see some more falls later on in the session. So pound Swiss franc downside might be quite good, or Euro Swiss franc downside. They're the other sort of pairs that I would consider. Folks, are there any questions? Please do ask away, but you know, this is quite interesting, really, what's going on. Salmon, hi. Yeah, good to see you. How's things? Let me know if I can help with any questions. Yeah, Salmon, great. What's your opinion in euro short term? Right, now this is somewhat more complicated. Looking at ECB, they have got a terminal rate now expected about 3.87%. And at the last ECB meeting, Salmon, what Christine Lagarde said was that a July rate hike was really probable, right? But after July, they're not so sure. We've had a flurry of ECB speakers basically saying that kind of message, like hiking in July, they're not sure. Look, says in September, a continuation of tightening policy is not certain, does not expect inflation to drop soon. That was Casimir, right? That's just recently. Villeroy says inflation has passed peak and the euro area, and future ECB decisions are to depend on inflation data. Most of the ECB rate hike path is complete, right? So that's Villeroy saying we've kind of done the job. That's our base case. ECB's reign, important to see core inflation and steady decline. Volchit says sometimes a soft landing is not possible. have to consider the risks of doing too much versus too little. Core inflation pressures remain. Okay, so that tells us straight away they're worried about the core. ECB story now says a further decrease in inflation is expected, but cannot exclude a further hike, but we cannot say now. It says decisions are data driven, right? They're highly data dependent. Inflation will come down next couple of years. Another hike in July seems appropriate. Right, so what you can see, you've got the picture now. So this means what traders are expecting, Salman, is one hike in July, followed by a pause. But then it's going to come down to the inflation data. And if we just take a look at the Eurozone, let's look when the next inflation data is. And we can see the next inflation, 19th of July is coming up, be big print. That's likely to move the euro significantly. And we've got CPI flash on the 31st of July. Looking at core inflation for the Eurozone, what we see is core inflation of 5.3. So it is stepping down. All of that means that I am neutral on the euro right now. Okay, I'm not necessarily expecting any big moves, but the ECB is data dependent and they're meeting on the 27th of July. So short term on the euro, I'm neutral. I think markets have priced in a lot of what's going on, but I would, if you put a gun to my head, what am I expecting? I'd expect US dollar upside, right? So I'd expect the euro to gain against the dollar because I'm expecting more dollar downside. So medium term, I would consider the euro US dollar a potential buy on dips. But as we've seen from all those ECB speakers, it's going to be dependent on incoming inflation data. And the ECB are really committing to a rate hike in July, but after that, they are saying they're data dependent. So markets will try to guess what the ECB will do based on the next inflation print. So I'm neutral with a bias for gains, but data dependent. Saeed, good question. What if the SNB raises 25 basis points and says we're data dependent from now? Very good question, sir. So SNB, if they raise by 25 basis points, then that would take it to 1.75%. And if they say they're data dependent, look, there's a whole lot of traders, short-term interest rate markets, that are saying we see another rate hike. But if the SNB say we don't see a rate hike, then all those people that expected 50 basis points will have to be pricing out. So that would be Swiss franc weakness. In which case, Saeed, I'd expect euro Swiss franc upside. And that would be a good trading opportunity. Remember, it's not based so much on the hike, it's based on the fact that they only would hike by 25 basis points and say we're data dependent from now. So Saeed, in that case, and it's a good question you ask, and thank you for asking it, it shows me your understanding is solid, then you'd expect the euro Swiss franc to gain because all of this would have to be priced out. Salman, any idea on maximum range for the next 3 months? Because I'll tell you why I don't know, and I don't want to give you an idea, is because of the data dependency involved. The Federal Reserve have said at their last meeting that they're data dependent, and the ECB have also said that they're data dependent. And both of them are looking at core inflation. So with the Fed, they're looking at core PCE print, which is their preferred measure of inflation. And the ECB are looking at core inflation. So we'll get a sense in the range of the euro and the dollar based on those inflation prints and those job prints. Remember, jobs are seen as inflationary and lack of jobs are seen as deflationary. But at the moment, Powell sort of said, maybe we can stomach a tight job market. We don't necessarily need to see a loose job market and happy just to see inflation falling. So both central banks have a major focus on inflation and on the data. So for that reason, Salman, I don't want to give a maximum range for the next 3 months because of it. I hope that makes sense. Gavra, what's your opinion regarding Ukraine? 300 billion for rebuilding, estimated for the next 10 years. Well, just obviously such a terrible situation with the poor Ukrainian people, and indeed, you know, there's no winners in war and death and destruction, and it's awful. Those poor soldiers on both sides. It's terribly sad. Regarding the 300 billion for rebuilding, estimated for the next 10 years, I think trying to project exactly what's going to happen with Ukraine over the next 10 years is a bit of a guess. And I certainly wouldn't want to be trying to project a way through that deeply unstable situation. Obviously, Ukraine has a lot of support from powerful Western allies, but Ukraine's also up against a powerful adversary in the shape of Russia, which is equally determined and powerful. So it's a very difficult situation. So I don't have any particular trades out of that, Gavra. Yeah, good questions, folks. Okay, don't forget, I'm back again on Monday, same time, and we'll look at the key events that are coming up next week. And we will have some decent events to be looking at, so please don't miss that, and I hope to see you soon. Yeah, no problem, Gabrielle. Thank you very much too. Take care, everyone, and look after yourselves, and hope to see you back on Monday. Thank you for the great questions and the input, and look forward to seeing you on Monday. Thanks, everyone now. Goodbye.